How did Peter Lynch manage to outsmart the Wall Street? What are you going to do when the stock you bought for $14 went to $6? And for how long are you going to fall victim to those harsh economic conditions? Everyone thinks of a market crash as chaos unfolding, but no one knows the underlying secret which Peter Lynch explains. Before we move on, make sure you press the like and subscribe button so that you don't miss out on anything related to passive income and stock market investing. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Peter Lynch was a legendary mutual fund manager at Fidelity Magellan Fund. He achieved a 29% annual return, absolutely crushing the stock market over 13 consecutive years. During that period, he managed to grow the fund size from $18 million to $14 billion. Afterwards, he retired early at 46 years old. And now, Mr. Lynch is sharing with us how to make millions during stock market crash. You should study history. According to Peter Lynch, history is the most important thing you learn from. Now, what you learn from history over the years is the fact that the market goes down, and it actually goes down quite frequently. The math is simple. For example, let's take the 20th century. The market had 50 declines of 10% or more, so once every 2 years, the market falls 10%. This phenomenon is also known as a correction. Now, out of those 50 declines, 15 have been 25% or more, and that's also popularly known as a bear market. That means we had 15 declines in the last 93 years of 25% or more. Also meaning that after every 6 years, the market historically is going to have a 25% decline. That's all you need to know. You need to know that sometimes the market is going to fall, and according to Lynch, if you're not ready for that, you shouldn't own stocks. It's actually good when the market comes down. For example, if you liked stock at $14 and it goes to $6, that's some serious good news according to Lynch. When you look at the company and its balance sheet and you find out that they're doing great, you're hoping to get to $22 with it. $14 to $22 is terrific, and $6 to $22 is an exceptional result. You actually take advantage of these declines instead of crying over why they're actually happening. Take advantage of the volatility in the market by simply knowing what you own. One thing is for certain, they're going to happen, but no one quite knows when they're going to happen. Don't buy a stock based on temporary circumstances. A lot of times, people buy on the basis of how much a stock has gone down over time, instead of understanding the stock more deeply. Most of the time, this is why people get themselves in trouble. Peter Lynch explains how Polaroid went down. When Polaroid went from $130 to $100, everyone was saying that here's a great company with a great record. Everyone wanted to get their hands on that Polaroid stock. But within a year, it went down to $18. Moreover, this was a company with no debt, which tells us that the company was overpriced and it had to go down. When Lynch was in his first or second year at Fidelity, Kaiser Industries had won from $26 to $16 a share. And at that moment, Fidelity invested one of the largest blocks ever bought in the American Stock Exchange. Then it went to $10, then it went to $6, then $5, then $4, and at last $3. At $3, Lynch figured out that there was something wrong with the Kaiser Industries. That is because Kaiser Industries owned 40% of Kaiser Steel. They also owned 40% of Kaiser Aluminium, and they even owned 32% of Kaiser Cement. They owned Kaiser Broadcast, and they also owned Kaiser Sand and Gravel and Kaiser Engineers. They owned Jeep, and they owned business after business, and they had no debt, which means that there were every possible reason to invest in them. It's extremely rare to go bankrupt when you have no debt under your belt, but you never know when your lucky star goes behind those dark clouds. So it was not long when the whole company was selling at $75 million. And at that point, it was equal to buying one Boeing 747. So the mighty Kaiser Industries had to give away all their shares to their shareholders. They had to give away the shares of Kaiser Cements, they passed out the shares of Kaiser Aluminium, they passed out the public shares in Kaiser Steel, and they gave out all the other shares. You get about $50 per share. The point is that if you didn't understand the company and you're buying on the basis that the stock went from $26 to $16 and then it went to $10, what would you do when it went to $9? What would you do when it goes to $8? What would you do when it goes to $7, $6, or $5? This is the problem people have. They simply sold stocks because they didn't know why they bought it. It went down and they don't know what to do about it. Simple as that. So what do we do when we see volatility in the markets? Volatility in the markets today. According to Peter Lynch, volatility is not something to be afraid of. Value investors should try to make the most out of it. The market is going to go up and down. Human nature has not changed a lot since 25,000 years ago. What's important are the callers because they play a pivotal role in keeping the market stable. Volatility is a great opportunity for people who know what they're going for. If they don't understand what they're owning, they can always go for those mutual funds. They can try to keep mutual funds and keep adding to it. Basic corporate funds have grown about 8% per year. So corporate profits double about every 5 years, and the stock market ought to double every 9 years. There is one thing about markets. You can always use history to predict if the market is going to go up or down. All you need to remember is a simple fact. If you put $1,000 in the market, all you can lose is $1,000, and all you can make is $5,000, $10,000, and $20,000. If you're looking to make millions in the market crash, grab our free ebook in the description below. It will help you to understand the 6 different stock categories that are important for every value investor to analyze and seize those once-in-a-lifetime opportunities. Remember that free knowledge is all you need on your journey to financial success to begin with. What do you think about market volatility? Have you ever invested during a bear market, or are you planning to invest during a market crash? Let us know in the comment section below. Subscribe and turn on notifications for more updates on financial literacy and stock market investing. Check out this video we handpicked for you, and we'll see you in the next one.